In this video, we're going to talk about amortizations as they relate to mortgages and loans. What is the amortization of a loan or mortgage? The amortization of a loan or mortgage is the amount of time it will take to pay off the loan or mortgage in full based on a specific principal and interest payment. A loan or mortgage payment consists of two components, which are a principal amount and an interest amount. The principal portion of a mortgage payment is the amount of payment which directly pays off a portion of the loan or mortgage. As the amortization of a loan or mortgage becomes smaller, the principal portion of the payment becomes larger. The interest portion of a loan or mortgage payment is the amount of interest payable to the lender for the payment period. As the amortization of a loan or mortgage becomes smaller, the interest portion of the payment becomes smaller. The reason the interest portion of the payment decreases as the loan or mortgage is paid down and the principal portion becomes larger is because the loan or mortgage becomes smaller. The amount of interest charged becomes smaller as well, yet the amount of the monthly or biweekly payment remains the same. For example, the monthly mortgage payment on a mortgage of $200,000 at a rate of 3% with an amortization of 25 years would be $946.49. The first monthly mortgage payment in this case would have a principal amount of $449.59 and an interest amount of $496.90. When this mortgage is paid down to an amortization of 10 years, the mortgage will have a balance of $98,107.64. At this time, the monthly mortgage payment would have a principal amount of $701 and an interest amount of $245.49. Since the principal portion of the payment increases in comparison with the interest portion, repayment of the loan or mortgage accelerates with time. It is possible for the term to be the same length as the amortization. This is very common with U.S. mortgages at the moment. However, in Canada, most mortgage borrowers opt for 5-year fixed-rate terms. If a borrower takes 5-year terms for the life of their mortgage and never breaks the mortgage during the term, based on a 25-year amortization, they will have 5 full mortgage terms, all with different rates than the other. If the borrower in this case is forced to renew into a higher fixed rate than the previous term, their mortgage payment will rise even though the amortization remains the same. This is because the interest amount of the payment increases while the principal amount of the payment remains unchanged. Now, the following is something that even people who are aware of amortizations, how they work, what they are, they might not know this, and it's an important strategy that can be used to meet your financial goals and at the same time protect you in the case of reduction of income or unexpected expenses. So here's the thing. Once you set the amortization of a mortgage, the amortization cannot be increased unless the mortgage is broken, and in most cases you would have to pay a penalty to break the mortgage. Lenders most often allow lump sum payments and payment increase options. These are known as prepayment privileges. Using these privileges, you can most often set your payment to pay off the mortgage in as little as 5 years, yet still register the amortization as 25 years. This will allow you to revert back to a minimal payment if necessary without having to break the mortgage. For example, let's say a lender allows a borrower to pay lump sum payments on any payment date to an annual total of 20% of the original mortgage amount without charging a penalty to do so. If the original amount of the mortgage at the beginning of the term is $200,000, the borrower is able to make lump sum payments of $40,000 worth of penalty-free lump sum payments in every year of the mortgage term. If the $200,000 mortgage is registered at an amortization of 25 years at a rate of 3%, the minimum monthly principal and interest payment on the mortgage would be $946.49, but the borrower would like to pay the mortgage off in 10 years. In this case, the monthly payment necessary to pay the mortgage off in 10 years would be $1,929.50. So, in order for the borrower to pay off the mortgage in 10 years, they would need to add a regular scheduled lump sum payment of $983.01 to their regular mortgage payment, which falls within the 20% maximum allowed by the lender, so no penalty will be charged to do so. Now, something to keep in mind is that any lump sum payment or increase of payment you make on your mortgage goes directly to the principal and reduces the amortization. Now, in this example, if for some reason the borrower wishes to lessen the amount of payment they are making once the regularly scheduled lump sum payments are in place, they can simply cancel or lessen the amount of the lump sum payment. This strategy allows borrowers to meet their financial goals without being obligated to maintain a higher monthly payment for the entire term. Well, thank you for watching. I hope this was useful. Please feel free to contact me with any questions you might have. You can go to my website or even leave it in the comments section and I'll get back to you. And if you have a mortgage coming up for renewal or you require any assistance with your mortgage, don't be afraid to give me a call or email me. It would be my pleasure to help.